Hi there, and welcome to another Stock Insights video on Stock Market Palantir. Make sure to hit the subscribe button and drop any comments. Now, let's go for the analysis.
Okay, let's just dive right in. $11.76. That's the number on the screen right now for Pure Cycle Technologies. We are seeing volume absolutely surging. Consistently moving between 6 million and 11 million shares daily, pushing the market cap to roughly, $2.12 billion. But if you are just looking at the green arrow on your trading app, you are missing the actual story here. This isn't just a ticker moving up. It's a powder keg. We are looking at a technical setup fueled by a massive fundamental disconnect. This stock has completely decoupled from the collapse of the wider clean tech sector, yet it remains one of the most aggressively shorted equities in the entire market.
It is certainly decoupled. I will give you that right out of the gate. But the central question we are wrestling with today is whether that decoupling represents a genuine market realization, a kind of coming to Jesus moment for the valuation, or just, a temporary bout of irrational exuberance. You see a powder keg ready to explode upwards. I see a valuation that is pricing in absolute perfection for a company that historically has delivered anything but. You mentioned the $2.12 billion market cap. That is a staggering price tag for a firm with exactly one facility that has only just managed to string together a single reliable quarter of production.
A single reliable quarter that's a massive understatement of the pivot we have just witnessed. Pure Cycle is effectively the singular survivor of the advanced recycling shakeout. We have to contextualize this for the listeners, because the graveyard is full. Between 2023 and 2025, we watched the Valley of Death claim almost every other player in this space. Danimer Scientific, gone. Origin Materials, fighting for its life on the pink sheets. Pure Cycle crossed the valley. My position is that the market is currently in the process of repricing Pure Cycle from a speculative R&D science project to a scalable industrial manufacturer. The Q3 2025 production record of 7.2 million pounds at the Ironton facility was the definitive proof of life.
Proof of life, yes. But proof of value? That is a much harder pill to swallow. I am not denying they survived. The bankruptcy of Danimer Scientific and the implosion of Origin Materials certainly makes Pure Cycle look like the valedictorian of a failing class. But let's look at the math. At nearly $12 a share, you are paying for the successful execution of a global rollout that has not happened yet. The market is trading this on a bull case scenario targeting $20 to $25, assuming smooth sailing for the Augusta expansion. I am looking at the massive capital intensity required to build that infrastructure. If Ironton suffers even one more mechanical seal failure, which, let's be honest, has been their Achilles heel repeatedly, we aren't looking at $12. We are looking at a rapid repricing back to the $5 range.
I understand why you are focused on the history of mechanical failures, but that is driving the car while staring in the rearview mirror. The operational turnaround in late 2025 wasn't luck. It was engineering. But before we get into the nuts and bolts of the plant, we have to address the immediate technical setup, because that is what is driving the tape right now. We are looking at a short interest of approximately 29% of the float. That is over 45 million shares sold short.
Which should tell you something. That isn't just retail money betting against a meme stock. That is sophisticated capital, hedge funds, institutional desks, looking at the unit economics and betting that the long-term margins simply won't hold up. They're betting that the physics of recycling trash into gold doesn't pencil out.
It is a liquidity trap. Look at the days to cover metric. It has ballooned to between 11.75 and 13.9 days. For those listening who don't trade actively, days to cover is the theoretical number of days it would take all the short sellers to buy back their shares based on average daily volume. In the modern market, anything over 10 days is a flashing red siren. It means the door is too small for the crowd to exit. We are seeing borrow costs, the interest rate you pay just to borrow the stock to short it, spike from 1.5% to over 7.6% in early January. The shorts are trapped in a valuation short that is becoming incredibly expensive to hold.
I agree the squeeze mechanics are present, but let's pause on the interpretation. High borrow costs and high short interest are often a leading indicator of something else. an equity raise. When a company with massive capital needs, like PureCycle has for its Augusta and Antwerp projects, sees its stock price inflate and borrow costs rise, they often use that liquidity to issue shares. If the stock price runs, management would be, frankly, technically irresponsible not to dilute shareholders to fund that growth. You are betting on a squeeze. I am warning about dilution.
I am not convinced by the immediate dilution fear because of the backing they have already secured, which we will get to. But stick on the technicals for a moment. We also have the regulation SHO threshold list invocations.
Okay, so break that down for us. Why does being on a list matter?
Essentially, if they stay on that list due to failures to deliver, meaning shorts aren't actually locating the shares they are selling, regulators force buy-ins. The brokerages have to go into the market and buy the stock, price insensitive. Plus, there is an options gamma dynamic here. Market makers are selling call options in the $12.50 to $15 range. To hedge their risk, as the price moves up, those market makers have to buy the underlying stock to remain neutral. It creates a feedback loop that has nothing to do with fundamentals and everything to do with market structure.
Market structure can drive price in the short term, absolutely. I've seen terrible companies skyrocket because of gamma squeezes. But gravity always wins in the end, and the gravity here is the fundamental valuation compared to its peers. Or rather, its deceased peers. Let's do a graveyard check. You mentioned the singular survivor. Why did PureCycle survive when Danimer Scientific went to zero?
Because the underlying chemistry and market fit were fundamentally different. This is the key insight people miss when they lump clean tech together. Danimer bet on PHA bioplastics made from fermentation. It was a beautiful idea scientifically, but the capex to build fermentation tanks is astronomical. You are basically brewing plastic like beer, and it takes forever. Frankly, the market didn't want a new, expensive material that required new tooling at the factory level. They wanted polypropylene. They wanted the same plastic they already use, just cleaned up. PureCycle survives because it sells a drop-in solution.
That is a fair point regarding product market fit. Danimer's fermentation costs were a capital expenditure nightmare, and Origin Materials pivoted themselves into oblivion by trying to become a cap manufacturer when their core technology converting wood pulp to plastic failed to scale. But loop back to Loop Industries, pun intended. They are sitting stagnant at $1.15. They also promised a recycling revolution for PET plastic. They failed because of energy costs. Their depolymerization process, breaking the plastic back down to monomers, was too energy-intensive. PureCycle uses a solvent-based physical separation. It is theoretically lower energy, yes, but they still face massive scaling risks as they move to Belgium and Asia. Being the best house in a bad neighborhood doesn't justify a multi-billion-dollar market cap.
It is not just about being the best house. It is about being the only house that is actually habitable. The failure of those competitors paradoxically strengthens PureCycle's moat. This brings me to the market decoupling. We have seen Danimer liquidate and Origin face delisting. PureCycle isn't just surviving, it is securing a monopoly on high-quality recycled resin. And this is happening right as the regulatory landscape shifted in a way that, well, nobody expected.
You are referring to the collapse of the UN Plastics Treaty.
Exactly. The failure of the Global Plastics Treaty negotiations in C5 was supposed to be a death knell for the sector. The argument was that without global mandates, the floor for recycled plastic prices would drop out because virgin plastic is cheaper. But look at what happened to PureCycle stock. It rose. It rose while the treaty was failing.
I come at that from a different angle. I look at the poly market data. We track these prediction markets closely. They were flashing red on anti-ESG sentiment. They correctly predicted the gridlock at the treaty negotiations. The sentiment is shifting away from global mandates. Without that global floor, PureCycle is reliant entirely on voluntary corporate commitments. You are banking on Procter & Gamble and L'Oreal being charitable enough to pay a premium for Pure 5 resin when they aren't legally forced to. In a recessionary environment, or even just a cost-cutting one, that green premium is the first thing to get cut.
That is the conventional wisdom, but the market action tells us that investors have figured out the flaw in that logic. The rise in share price during the anti-ESG wave on Polymarket suggests that smart capital views PureCycle not as a subsidy-dependent ESG play, but as a technological industrial play. They are competing on utility. And regarding the regulatory vacuum,
It is not a total vacuum. We still have California SB 54. We still have the EU's packaging and packaging waste regulation. Those didn't go away just because the UN couldn't agree.
They didn't go away, but they are a patchwork. A patchwork is much harder to navigate than a harmonized global standard. It makes the logistics for a multinational a nightmare.
But that patchwork creates desperation for the multinationals. That is the bull case. If you are P&G and you have to meet California's strict food-grade recycled content laws, where do you go? You can't use mechanical recycling for food-grade polypropylene. It smells, it is gray, it is contaminated. You can't use pyrolysis, chemical recycling, at scale because the yields are too low and the energy cost is too high. PureCycle is literally the only game in town producing FDA-grade, odorless, ultra-pure recycled resin. The failure of the global treaty means there is no flood of commoditized, recycled material coming. It creates quality scarcity. P&G has no choice but to pay the premium.
No choice is a dangerous phrase in economics. There is always a choice. They can switch materials, they can lobby for exemptions, they can switch to PET. But let's assume the demand is there. My concern is, and always has been, the supply side. Can they actually make the stuff reliably? We have to do some operational forensics here. You cited the 7.2 million pounds in Q3 2025. That is a good number, I admit, compared to the zeros we saw before.
It is a transformative number. We went from 3.5 million pounds in the entire first half of 2025, plagued by downtime, leaks, clogs, to 7.2 million in a single quarter. That is an annualized rate approaching commercial viability, and critically, they completed the in-house compounding lines.
Explain why that matters so much to the valuation.
Margin capture. Previously, they produced neat resin, just raw pellets. That resin had to be shipped to a third party to be mixed with additives or colors, then shipped to the converter to be made into a cap. PureCycle was leaking economic value at every step of that logistics chain. By bringing compounding in-house, they capture that margin. They can ship ready-to-mold pellets directly to the converter. They are engaging in just-in-time manufacturing for sustainability. It deepens the stickiness with the customer. If they're making a bespoke formulation for P&G laundry caps, P&G can't just switch to a competitor next week.
That sounds excellent on a PowerPoint slide. I'm sure the investor deck looks beautiful, but let's look at the history. This is a company that struggled for 2 years with co-product agglomeration, essentially sticky waste clogging the pipes, and screen filtering issues. The turnaround in late 2025 followed a massive strategic outage in June. They fixed the seals, yes, but chemical plants are living organisms. They break. The valuation today assumes Ironton runs at nameplate capacity, 107 million pounds forever. If they hit a snag, if they have to shut down for 3 weeks to clean a column, the unit economics collapse. You mentioned P&G? Let's talk about the commercial launch.
The commercial launch is happening now. P&G launched the Pure 5 resin in laundry caps. We saw the activation at the college football playoff, the Run It Back Cups. This is the transition from R&D story to consumer reality.
It is a nice marketing activation, but I noticed something else in the filings. The appointment of Valerie Mars to the board in December 2025 signals something less optimistic to me. While the bulls see it as a strategic partnership with Mars Inc., I see it as a signal of feedstock anxiety. PureCycle needs waste. Specifically, they need polypropylene waste that isn't too contaminated. The open market for feedstock is volatile. Bringing a Mars family member on board suggests they need to secure a closed-loop supply of candy wrappers because they can't rely on the open market to feed the beast at the prices they need to maintain margin.
Or it suggests that major industrial players want to own a piece of the infrastructure because they know it works. That brings us to the smart money argument. You can't ignore who is backing this. Sila Brad Capital and the Duquesne family office, Stan Druckenmiller's vehicle, they put $300 million into this company in June 2025.
Being followed by smart money doesn't guarantee a return. Smart money makes mistakes too. I can list a dozen companies Druckenmiller has exited at a loss.
True, but look at the timing. They wrote that check when the company was on the brink, when the mechanical failures were at their peak. They didn't do that blindly. They had engineers in that plant. They saw the fix before the market did. Silabra isn't a passive index fund. They act like a private equity sponsor. They have effectively backstopped the liquidity risk. They built the bridge that allowed PureCycle to cross the valley of death.
They built a bridge, yes, but bridges have tolls. The equity dilution that came with those raises is real, and Cyclabra's presence creates a floor, perhaps, but it doesn't guarantee the ceiling you are projecting. My issue is that the stock is currently trading at a multiple that implies the Augusta plant is already built and generating cash. Augusta is a multi-billion-dollar project. Where is that money coming from?
The money comes from the demonstrated success at Ironton unlocking traditional project finance debt, bond markets, essentially, plus the non-dilutive capital they are accessing. Look at the €40 million grant from the EU Innovation Fund for the Antwerp project. That is free money, and more importantly, it is political cover. It shows the EU regulators view PureCycle as essential infrastructure.
Grants are great, but they don't billion-dollar plants. They will need to tap the equity markets again. And that brings me back to my core fear for the retail investor here. You have a stock that has run up on a short squeeze narrative and a single good quarter. If the company announces a $500 million equity offering to fund Augusta, this stock drops 20% overnight. The days to cover won't matter if the company floods the market with new shares.
But that is assuming they need to dilute immediately. With the Simpliprec cash and the revenue ramp from Ironton targeting over £10 million in Q4 2025, they have runway. And let's look at the upside. If they hit the bull case scenario, 100% capacity at Ironton, selling at $1.60 per pound, we are looking at $170 million in revenue just from Ohio. Apply a growth multiple to that because of the global pipeline, and the $20 to $25 target isn't fantasy, it's math.
That is the definition of pricing imperfection. You are assuming $1.60 per pound. That is a massive premium over virgin resin. That assumes oil prices stay where they are or rise. If oil crashes, virgin plastic becomes dirt cheap. You think P&G will pay 3 times the price of virgin just for a sustainability claim in a non-mandated market?
Yes, I do, because of the oil price decoupling. We have seen this. Oil prices have softened to the $58 to $66 range, yet PureCycle's pricing power held. Why? Because they aren't selling a commodity. They are selling a molecule plus a certificate. They are selling regulatory compliance and brand safety. The price of oil could go to $40, and it wouldn't change the fact that mechanical recycling can't remove odors from post-consumer waste. PureCycle's utility is decoupled from the barrel of oil.
That decoupling is untested in a prolonged recession. If consumer spending dries up, premium products are the first to go. I also worry about the technological industrial play narrative. It sounds sophisticated, but at the end of the day, this is a factory processing trash. The margins are capped by the cost of that trash. You mentioned feedstock agnostic capability, using dirty carpet fiber. That is harder than it sounds. If they have to switch to cleaner, more expensive feedstock to keep the machines running, those 25 to 30% gross margins vanish.
They have proven the purification technology works on high contaminant loads. That is what the Run It Back program was about. Taking stadium trash, which is nasty stuff, full of beer and soda residue, and turning it into souvenir cups.
A souvenir cup is one thing. Running 24/7 for 365 days a year is another. We have to be realistic about the execution risk that remains.
I am being realistic. I am acknowledging the risk, but I am weighing it against the asymmetry of the trade. You have a company that is the only one left standing, you have a massive short position that is trapped, you have a commercial rollout with the biggest CPG company in the world, and you have a technical setup where the days to cover is screaming squeeze.
And I see a company that has burned investors before. The short interest is high for a reason. It is a warning sign, not a dinner bell. The 29% short interest tells me that 29% of the market thinks this is going to fail or dilute.
Or that 29% of the market is looking at old data and hasn't realized the bifurcation event has already happened. The anti-ESG trade is overplayed. PureCycle is an industrial efficiency story now.
To wrap up my view, PureCycle has done an incredible job avoiding the grave. Avoiding death is not the same as being a good investment at $2 billion. The share price at $11.76 leaves absolutely no room for error. The thesis relies entirely on Ironton maintaining 100% uptime and that premium pricing holding up in a non-mandated global market. If anything slips, a pump, a seal, a contract, the valuation compresses.
The short interest isn't a gift. It is a signal that the smart money still doubts the durability of the technology.
I see it differently. The market is incorrectly pricing PureCycle as a distressed ESG asset when it has proven itself as a scalable manufacturer. We are looking at the convergence of a technical short squeeze, 13 days to cover is undeniable math, and a fundamental catalyst in the P&G commercial launch. The failure of competitors like Danimer only deepens the moat. PureCycle is the only game in town for high-quality resin. The risk-reward here is asymmetric, targeting $20 to $25 as the shorts are forced to cover into a rising fundamental tide.
We will see if the tide lifts the boat or if the leaks spring again.
If you like this video and want to watch more content like this, don't forget to subscribe to the Stock Market Palantir channel. Thanks for watching. See ya!